for week 5, we are going to be looking at the bottom half of the 1040. I have pulled up here the items that are due, the things that you can access, the lecture notes. Make sure you have those out as we're going to be going through those here momentarily. We're also going to look at this practice tax return. I'm going to most likely have a separate video for this one for those that just want to see the tax return done. I highly recommend doing that before you get to the shoebox and the end of the chapter tax returns for 3 and 4. I think it'll be very helpful for you. Okay, so this week we are going to look at the bottom half of the 1040. In week 2 we looked at the filing statuses and the exemptions. In week 3 we looked at just actually preparing a basic tax return. Last week in week 4 we looked at the top portion of the 1040, or the middle section here, the income section. And now we're going to look at the bottom part of the page 1 for any adjustments that are going to be made to the 1040. Now there are quite a few of these that are actually going to be going away in the near future, as I will have outlined on your notes. These with the new recent tax plan that was by the Trump administration in late 2017, some of these will be going away at the end of 2017, starting with the 2018 tax year. We are still going to cover those because these are temporary items. They have not been finalized to be listed forever off the tax return. Most of these will, or this tax law will expire around the year 2024 into 2025. So these could potentially come back, and they're also relevant for this tax year as well for the 2017 tax year. Okay, so once we get done with this, we're going to get to a very important number, the AGI. AGI is used a lot, the adjusted gross income, for a lot of items, not only on the tax return, but elsewhere. Other entities look for your AGI, your adjusted gross income, to see where you stand financially if you get any tax break, if you get any, say, medical breaks on bills or whatever else, if you fall into certain poverty guidelines. Okay, with that, I'm going to open up my notes for chapter 4. There's not a whole lot that we're going to be covering in chapter 4. It's a pretty easy area of the 1040. And it will get easier as 2018 begins. So with that, we're going to also cover after we get done with chapter 4 material here, we're going to cover the Obamacare. It's slated to be to go away at the end of 2018, so it's still going to be in effect for 2018. But as starting 2019, right now, how the tax law is written, it is you are not required to have health insurance anymore. Who knows how that will change if different presidents come in? That could very well change as well. So we're going to continue to cover that for the time being. Chapter 4, the adjustments. All right, so all these deductions, if you ever hear the term above the line deductions, that's what these are. The line is AGI, and it's the bottom part of the 1040. When you turn it over, page 2, then those are considered any below the line deductions, and most of those are either your standard deduction or your itemized deductions. All right, I'm going to cover these in the order that they appear on the 1040. I'm not going to hit every single one, but most of them that you may see we will hit. The first one here was slated to potentially be taken off of the 1040, but it was renewed. It's going to continue to be there, the educator expenses. This one is just kind of the government throwing out a freebie. It doesn't hurt the government hardly any. It doesn't help out the taxpayer very much. Notice it's only available for K through 12 teachers. And the absolute most that they can take off on their return is a whopping $250, which is very small. If you take off $250 off your taxes and you're in the 15% bracket, I did the calculation here that it's going to save you $37 off of your taxes. So it's better than nothing, but teachers spend usually a lot more than $250, but they can only take $250 off. And the government was wanting to remove this one I could see them removing it just because it's so small, but it's not hurting them hardly in any. Notice this also does not include homeschooling. Also, it would not include any college instructor expenses. All right, moving expenses, the next one down. This one is slated to be removed beginning for the 2018 tax year. It is still going on for the 2017 tax year. It is still allowed. So we will be covering this. We're going to note some of the items that have to be in effect for this to even be relevant, for this to even be you allowed to take this. Notice the taxpayer has to change job sites. They don't have to change companies or positions, but they do have to change locations. Just because you move to get closer to your job, perhaps, doesn't count for a moving expense deduction. If you kept with the same job, the same site, and you just decided to lessen your commute and you wanted to move, you don't get a deduction just for that reason. There's this distance test that you have to, and you have to read this real carefully for it to even make sense. Your new workplace must be at least 50 miles farther from your old home than your old job location from your old home. All right, I tried to break this down into a little bit easier things to understand using things around Indiana. So if your employee lived in Anderson and had the old job was in Indy, and they traveled 47 miles. To qualify, let's assume the employee got a new job, a new site in Evansville. That commute from Anderson to Evansville must be more than 97 miles, the 47 plus 50 further. Then as long as the commute is more than 97 miles, then they would be allowed to take a moving deduction to move to Evansville or anywhere around there. And the trip from Anderson to Evansville is more than 97 miles, so they would qualify. The trip to Evansville to Anderson is probably closer to 200 miles, because I know it's from Anderson to Bloomington, which is about halfway, is 100 miles. So that's the kind of gives you an example of what would be allowed for a moving deduction. And also for the moving deduction to count, you do have to be at your new location for at least 39 weeks. You can take the deduction before you've even been there 39 weeks. So you can take it on your current year tax return. But if you would happen to change jobs again, and then this one would be wiped out, and you would have to actually add back the income on your future tax returns. The amount that you took off this year for your moving expenses, you would have to actually add back in another year or go back and amend your prior return, whatever one is more convenient. Qualified moving expenses, you are allowed to take any expenses that help you to move from one household to the other, and that includes a professional moving company. Or if you do it yourself, the cost of the moving truck. You're also allowed a per mile, or you can take the gas receipts, whatever is more. You're also allowed that one night of lodging. And when I say this per mile, this doesn't include back and forth. This includes a one-time trip to get down there. You can't take multiple trips and count all of those miles. It's just a one-time item. Notice here there's no deduction allowed for the eating of the meals. You're going to have to really eat anyway. They're not giving you any deduction there. And then any of the other expenses that may come along with moving, if you have to have some temporary living expenses, you are allowed a one night, possibly maybe 2 nights stay as you get the house ready to move into and all the furniture moved in, but not like a month or two. That would not count. All right, so we'll move on here to half of self-employment tax. The reason they give you this is when you are a self-employed on your Schedule C, and we're going to look at this at the second half of the semester, you have to pay tax on your total net income. You have to pay this self-employment tax, which is your Social Security and Medicare. Now, if you just had to pay your part, there would be no problem. But you also have to pay the employer part, which as an employee you never see. But if you are your own business, you are the employee and the employer. So you have to pay a total of 15.3% of your net income, whereas a typical employee only has to pay 7.65% because the employer is required to pay the other half. So to give a little bit of help back, what they do is whatever your self-employment tax is, you're allowed to take half of that self-employment tax as a deduction. It's not a big help, but every little bit does help a little. We'll see this coming up. We're not going to really see this in this week's material or even this first half of the semester, but when we get to Schedule C, I'll be sure to come back and show how that comes out, where that self-employment comes up. Self-employed health insurance. When you're self-employed, this is one of the items you cannot take as a deduction on your Schedule C. It's one of the odd ones, and I've never really been given a good reason why you can't deduct self-employed health insurance. When you compare it to being an employee, employees do not pay Social Security and Medicare taxes on the health care premiums that they have to pay through their job. Say you have to pay $100 every 2 weeks for health insurance. That gets taken out of your paycheck, but it also gets taken out of your taxable income. So you're not taxed on it for those Social Security and Medicare taxes. However, as a small business, you are not allowed a deduction. So therefore, you are paying Social Security and Medicare tax on your health care payments, which does not seem fair. So you are paying tax on those, but when they allow you to take it as a deduction on the 1040, at least you're not paying federal income tax then on those payments, because at least you're being able to take that off of your adjusted gross income, where your federal taxes are calculated. So it's something that's pretty unfortunate for a small business. So as you can see here, as I put, this deduction for paying your health insurance premiums is only helpful for reducing your federal tax liability, not for FICA taxes for Social Security and Medicare. You can deduct your health insurance if the business pays health insurance for your employees. You are allowed to deduct those on your Schedule C, just not for yourself and your own family. Alimony deductions. These are slated to go away beginning in the year 2018 for those 2018 taxes done in 2019. Notice this is only going away for those divorces that are after 2018. If you have a divorce before that, you're still going to fall under the grandfathered rules where you are allowed a deduction for alimony payments that you make. Remember last week, alimony payments that you receive are taxable. Now, this doesn't really affect most people in Indiana because Indiana is a non-alimony state. But if you would happen to work elsewhere, this could definitely be something that you would have to be aware of. Notice this does not include child support. Child support is tax-free to the recipient and is not deductible by the payer. But as of right now, for 2017 tax year, you are allowed a deduction for any alimony payments that you make, and alimony received is taxable. IRA deductions. You are allowed a deduction for any money you put into a retirement account. Now, there are quite a bit of rules and income limits. We are going to get into that in much greater detail in week 9, but I just wanted to at least introduce it here, that it is an adjustment to your income. And as long as you meet the guidelines, you are allowed to contribute and deduct $5,500 per person. And then therefore, if you are married, you can deduct up to $11,000 on your tax return. Now, again, there are quite a few stipulations that go along with that. So not just anybody can do that. If you're over 50 years old, that is where they call it a catch-up period. You are allowed an additional $1,000 per person, so you could get up to $13,000 for married filing joint. Student loan interest. This one was on the table for potentially being knocked out with the new tax changes. It was there was a big uproar about it, so it is kept. It will stay for now and then going into the future. Student loan interest, so any interest that you pay back on your student loans is deductible. Note, however, it is capped at $2,500. Once you pay over $2,500 in interest, then you do not get any more deduction. And note that is for both single and married filing joint. Therefore, this is considered a marriage tax penalty. Because if you had two single people living together, they could both take $2,500, but you marry them and then together they can still only take $2,500. So you could potentially miss out on a $2,500 deduction if you both, husband and wife, both had over the $2,500 in interest payments. There is a phase out here where if you are over the guidelines, you cannot take this interest deduction. And I'll work through how this phase out works. But mainly, what I like to do is this is the absolute bottom number. So anything below this, if you're single or head of household, you can take the full $2,500. If you're over $80,000, you can't take any of it. But then if you're in between, there's a little bit of a formula that we're going to look at here. Married filing joint, the number is exactly doubled, so therefore there is no marriage penalty in the phase-out area, which is good. So here's my little example. What if you are in between the $65,000 for somebody who's single and the $80,000? How much of the $2,500 deduction can you take, if any? So here's my example. Somebody's at $70,000 AGI, and they have $2,800 in student loan interest. Well, even if this number wasn't above the phase-out, the max that we could possibly take is $2,500. So that's the number we're going to be looking at is $2,500, not $2,800. That's gone over the limit. So here's how we do it. Here's the easiest calculation, and this is different from how the book does it. The book has you take an extra step. I've taken the middleman out, and I just have the easiest formula possible. Take your top phase-out number, 80,000, or 160 if you're married filing joint, but we're dealing with a single. 80,000 minus the 70 is $10,000 left. And then you take that 10,000 and divide it by your span, whatever the span is in your category. In the single or head of household, it's $15,000 is that range. So take 10 divided by 15, and when you do that, it's 2/3. So we are allowed 2/3 of the absolute most we could have possibly taken with this tax year. Because we had $2,800, we don't take 2/3 of that number. We take 2/3 of what absolute most I could have taken. Now, if this number would have been $1,300 that we had paid in student loan interest, I would have taken 2/3 times 1,300, not the 25. The 25 is because that's what I could have taken if my AGI was not as high as it was. So therefore, I'm only allowed to take a $1,667 student interest deduction at most. I have a second example here just to show one more time if it's married filing joint. Take the top number. Since we are over the bottom threshold of 130,000, husband and wife interest, they both combined are still less than 2,500. So the most we could have taken, even if AGI wasn't involved, was 2,100. So take the 160, the top number, minus 145, we got 15,000. 15 divided by the span was 30. So that becomes 15 over 30 is half. We're allowed to take half of the $2,100. Therefore, it is $1,050 as our allowable student loan interest deduction. Notice here one of the rules, only the person legally obligated to make the payment is allowed to take the deduction. There are, of course, loopholes that you could potentially work around. Tuition and fees deduction. I'm going to skip through this because this did expire as of the 2016 tax year. We're not going to really, even though we are currently preparing 2016 taxes still using our tax software, we're not going to have this come up as any type of a tax return issue. Any education items that we have, they will be using credits, using either the Lifetime Learning Credit or the American Opportunity Credit, which we will discuss in a lot more detail in week 7. All right, that finishes up chapter 4, all of those below the line deductions. The second part of this lecture I did want to look at, and we'll take about the next 10 minutes and look at the Obamacare healthcare rules that are still going to be in effect for not only the 2017 tax year, but also the 2018 tax year. The going away stipulation doesn't start until the year 2019. All right, so one of the stipulations that has been in effect was if everybody has to have insurance, then that means everybody's paying in premiums or you're paying a penalty. And therefore, if everybody's paying in premiums, that knocks down premiums for everybody across the board, even for those people who are usually pretty sick and require quite a bit of medical attention. Their premiums usually would be going up. But since everybody has to pay in, that helps distribute the amount of burden. So everybody paying in, it's kind of you could look at it either way. It helps out some, but it kind of hurts others who maybe aren't sick, but yet they're being forced to pay in. This healthcare, you can get healthcare through any means that you need to, but if you're going to qualify for the tax premium credit that potentially you could get on your tax return, you have to purchase your items through the marketplace. You do not qualify for a premium tax credit for your health insurance payments if you buy them through anything else. If you buy them just on your own through your own insurance company, if you get it through your job, doesn't matter. The only place that you're eligible to potentially get a premium tax credit if you have overpaid is through the marketplace. All right, so this shared responsibility provision, this is if you do not buy health insurance, you are going to be taxed. They call it a fancy name here, shared responsibility, but it is basically an additional tax, and the tax can be quite steep, as we're going to look at here in just a minute. There are a few people who are exempt, and we are also going to look at who those would be from having to pay this tax. Anybody that you claim on your tax return will have to have insurance, or you have to pay a tax, or you have to pay the tax on that person. You can always choose not to claim the person and therefore not have to pay the tax on them. But if you do claim them as a dependent, then you will have to have insurance on them or pay the penalty. So here is the penalty. I left these first 2 years on here just to give you an idea how the increase has continually went up. Back in 2014, the family maximum was only $285, which sounds like a lot, but when you compare it to 2015 and then 2016, it's not much at all. Notice how much it jumped in the year 2015 as they were beginning to phase it in, from $285 up to $975 max, and now for 2016 and beyond, so including the 2017 year, the max is $2,085. And what that means is you're going to pay the greater of. A lot of times in taxes, it's always the lesser of, but this one is the greater of 2.5% of your household income, or less your filing threshold. So your household income, say you made $50,000 at your job, you do get to take off your filing threshold, which if you're, say, single, that's $10,350 for the year 2016. You do get to take that amount off like a standard deduction and personal exemption. You pay 2.5% of your income, basically your taxable income, or the greater of that, or $695 per adult on your return, plus $347.50 for any child on your return. And then again, the max would be $2,085. $2,085 comes out to be exactly if you have 2 adults and 2 kids on your return. If you add up 2 adults, 2 kids, it will come up to $2,085. So again, just to remind you, each dependent that you claim must have insurance. Otherwise, you will pay one of these 2 amounts, or potentially the greater of up here. You can choose not to claim that certain individual, and therefore you won't have to pay the penalty either. But if you don't claim the individual, you may not get certain other benefits. So sometimes it's just best to go ahead and claim them and then pay the tax. So when they say household income, they actually mean that. Household income, you got to include all of the income of your dependents to see where you stack up, because you do get some benefits if you are lower income, and I'm going to show you that in a little bit. And the income does go actually pretty high up to still be considered eligible for a deduction, a potential credit on your return. What I wanted to do here is just show you an example of how much somebody might have to pay in a penalty. Jim, who is unmarried, 40 years old with no dependents, he did not have insurance. His household income was $40,000, and his filing threshold is $10,400, I believe. So that is for the for the 2017 tax year, not necessarily for the 2016. So if we're going to look up how to figure out how much tax he's going to have to pay, we have to do 2 different items. We have to find the greater of 2.5% of his actual taxable income, or his $695. Remember, that was the amount per adult. So when I take $40,000 and subtract out his filing threshold, we get $29,600. 2.5% of that $29,600 is $740. We take the greater of that number, $740, or the flat dollar amount of $695. Therefore, Jim is going to need to pay on his tax return for not having insurance $740. Now, if you're somebody that had insurance for at half the year, then you don't have to pay the full amount. You only have to pay the number of months that you actually did not have insurance. So if you didn't have insurance for 6 of the 12 months, then you would only have to pay half of the $740. Here's another example that you can do on your own. If you want, go ahead and pause quickly, work through this one, see what you get, and then I'm going to pull up the answers. Okay, here come the answers to our Obamacare example number 1. We take their income, $70,000, subtract out $20,800. When you get that, they have a taxable for this piece of the Obamacare, $49,200. Take that times 2.5%. That equals $1,230. Remember, it's the greater of that number or the amount per kid and per adult at and then a family max of $2,085. So the family max is $2,085, and that is more than the $1,230. Therefore, that is what they are going to pay because they had two adults, 2 kids, total of $2,085. Okay, here's a couple of the exemptions where you do not have to have health insurance if you meet some of these guidelines. The first one is called the Unaffordable Coverage. It's somewhat common for those with pretty low income, and I'm talking somewhere in the range of less than about $20,000 if you're single, and probably less than about $30,000 for married filing joint. You may fall into this unaffordable coverage. I'm not going to go through it in this lecture, how to actually go through it, but you can follow these guidelines if you are interested, and I highly recommend you try it, do it. And then I can post the answers to my examples down here. Just email me, and I will gladly send those to you, and you can see how you did. There's just 3 steps that you need to do to figure out if you do qualify as unaffordable coverage. So take a little bit of time and do that, but I'm not going to do that here because we spend quite a bit of that in our payroll class, and you can get to that when you have payroll, and we will go through this in more detail. But I give you the answers for this first one, so you may want to go through and just check through on how I did it. Here are some of the other exemptions that you could possibly have that allows you not to have insurance. A short coverage gap means that you went without coverage for only 3 months, 3 consecutive months during the year. Now, if you had it, say, February through say April, and then again October through December, only the first one counts. The second 3-month span would not count. You would be considered as having no insurance, and you would have to pay the penalty for those 3 months. Now, when they say 3 months, this is 3 consecutive full months. So if you started in February 15th, February doesn't count as a month. You are still counted as having insurance because you had insurance at least 1 day during February. It's kind of a weird little side rule that it's not real clear, but that is how it is written. So if you didn't have insurance starting February 15th, your first month of insurance wouldn't be considered until March. So you would have March, April, and May as potential freebie months as long as you got insurance at some point in June. Then you could still meet that short coverage gap. If your income is below the filing threshold, you do not have to pay. You're automatically exempt. Even if you still file a return to potentially claim a refund, you will not have to pay the shared responsibility tax. This number 3, I think, is one of the worst ones on here. If the taxpayer was not a U.S. citizen and not lawfully present in the U.S., they are considered exempt. So if you meet this, it's a weird exemption. I'm sure if they get sick and go to the hospital, they'll still have to take care of them, but they do not have to pay the tax for not having insurance. Okay, if you're in jail, you do not have to have insurance. Certain members of a religious sect, these are very few and far between. As long as you are recognized by the Social Security Administration and you are opposed to accepting any benefits like Medicare or Social Security, which are going to be very few and far between, then you do not have to have health insurance. So not just anybody can say my religious beliefs don't allow me to have this. That doesn't count. Okay, let's keep coming down. Minimal essential coverage basically means you have full medical benefits. Having just dental benefits doesn't count. Having just there's different things on here that you'll see, things that are not considered essential coverage, but most of them are kind of obvious that they would not be considered coverage. If you did have the marketplace taxes, insurance, you will get a form 1095A in the mail. You will definitely need this to do your taxes. This shows how much you paid each month in premiums, and that goes into your tax return to see if you paid the right amount. And if you paid the exact right amount, then you won't owe or get anything back. If you paid too much because your income was lower than you thought it would be, then you'll actually get a premium tax credit back. If you didn't pay enough because your income was higher than you thought it would be, you'll actually have to pay that back as well. And that's what I go through here in the premium tax credit in the advance payments. The last thing here that I wanted to touch on is who can potentially get benefits by having a lower premium because of your income level. And the key is if you are less than 4 times the poverty level, so that's 400% of the poverty level, you do qualify for getting a deduction on how much you would have to pay. The government will help put in some of that money for health insurance to make your premiums go down. So if your premiums would have normally been $400 a month, if you meet certain guidelines, it continually goes down, 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 all the way up to 400%. You will get at least something back if you have 400%, if you're lower than that. And I wanted to give you an idea of what the poverty levels were as of the 2016 year. 400%. So if you're just a one-person household and you're not married, you don't have any kids, if you have income of less than $47,000, then you would qualify for some kind of a help on your premiums. And notice how much that goes up for a family of 4, so you're potentially married with 2 kids. As long as you have income of less than $97,200, then you will get a little bit, at least, benefit. The lower you make, the more of a discount you'll get on your premiums. Okay, with that, I'm going to stop this lecture, and I'm going to then go into the second lecture of the going through the tax return for this week.